All right, everyone. Welcome to what we're calling the Unfair Advantage Stock Market Cheat Sheet. Now, you are either watching this as a member of the newsletter, and this will help you kind of set yourself up for success. Whether you've been on the newsletter a while and need to reset, or whether you're new to the newsletter, this will help you have a foundation for understanding the approach to the stock market that is much more than just investing. And this approach allows you to build what I consider to be the most consistent way of gains that the stock market can provide you. Because the stock market is a wide array of opportunities, and how you approach it is what allows you to pull out what you really want to. And every one of us has different individual goals that we are in the stock market for. Some of you may just have started out investing. Some of you may want to be more informed because you're not sure if the person that is giving you advice or the person you are paying to give you guidance has your best interest in mind, or you just want to be able to articulate what you want to accomplish to them. That is the foundation of how you build out an eventual stock market asset, is the way I look at it. Because a lot of people just use the stock market as a place to invest for the long term, buy and hold. And while that is a very powerful way to build wealth in the stock market, you can add on pieces to that begin to build a stock market asset that produces ongoing gains that then can quadruple, 5x, or even 10x your results in the stock market long term, so that it eliminates the fear of, am I going to have enough when I decide to use this money to live off of, or retire, or build from? See, that is the key. A lot of people just use their income to provide an offshoot of and invest in the stock market long term. And while I can show you charts that prove that stock market gains over a 10-year period of time anywhere in the stock market going back to 1900, if you reinvest the dividends, you would never have a losing year. This is proven. I would still say that you're leaving a lot on the table unless you're a real high income earner, if all you're using is your trading hours for dollars income to build stock market wealth. And so the idea here is the unfair advantage stock market cheat sheet for consistent gains, because I want to lay a foundation out of how I was taught and I have seen people build profit cycle businesses from the stock market. And so this comes along with a PDF checklist for you to be able to build out what you want to accomplish in the stock market, with first understanding that it's not just long-term investments. It's building out what I consider to be 3 troughs of profit. And those 3 troughs are starting with looking for investment, and then looking from investment and through it to not just retirement. So show this next one, Lee, for me. The idea here is you're investing for more than retirement. That gives you the beginnings of the unfair advantage. Everyone out there is holding, just looking to eventually see the stock rise to a point that they really don't know when that point is, but a point where they feel that they have made what they want to from their investments. But as you can see, investing for more than retirement allows you to buy for wealth and plan to win when you buy. Now, I do that using a particular method, buying into strength with confidence, buying when everyone else is confused, insure stocks like you insure your home. So let's take the first piece there, buying for wealth and planning to win. Come on back, Lee. Here's the thing. To begin to establish yourself in investments, you have 6,000 odd stocks to choose from. How do you choose it? That's the unfair advantage that a professional approach has, that you can have over everyone else. That approach of Okay, I'm not just going to buy anything. I'm going to look for and build out a list ahead of time, pre-plan, 10 to 12 well-chosen stocks that I want to own the entire company of if I could. Now, all of us are not billionaires, so you may never get to that point. But the idea is looking at it from an approach of, if I could, I would. You have that list prepared, and you prepare that list by a very simple approach I look at: finding stocks that are global, optionable so you can insure, and we'll talk about that in a minute. Finding stocks that allow you to play the long game of about 5 to 7 years of growth in that company, where it looks like it's needed and has on the horizon advancement in the field that they're in. You know, John Deere is a company that is on the rise because they are advancing in their field of performance in agriculture. Cat Tractor, construction, they are one and the same. They are known for building quality construction equipment. Lowe's, for the next 7 years, there's going to be Lowe's in your community that are going to be the go-to place, especially with the falling off of a lot of other building supplies locally. They're going to be the place that you go to if you want those kinds of things. It's the competitive advantage that you can see right out with your open eyes. And then you go and you look at the books and you look at the cash flow and you see if the cash flow and the revenue support that. With growing earnings of the last 10 quarters I look at, you know, if 7 to 8 of them are growing, okay, I feel pretty confident about that. So global, optionable, growing earnings for a period of time. And then the idea that they have a competitive advantage. And then the idea that they are owned by other professionals. You figure this out by simply going and searching. There's hundreds of mutual funds or funds out there that are owned by and managed by large corporations. These funds share their holdings, especially their top 10 holdings. And if you look at across the board, 5 or 6 different funds that are named like some really cool thing, like Growth Advantage Fund or Tech Stock Super Fund, those names are marketing. But the ownership in the top 10 holdings, if they match over 3 or 4 or 5 different funds, every fund that owns a stake in the same company in their top 10, maybe not the same percentage, but the same stake, that's a competitive advantage, man. That's where we can find our way to winning the game of, we don't have to be the person in the room that knows everything. The people that have a lot of money, that are investing billions of dollars, already proved to us that they'd love to own the entire fund in that top 10, but they can't because they're not allowed to, and they have to keep digging down the barrel. But you can buy as much of those top 10 as you want. So you look across the board and you find, okay, I've got a list, my list of top 10, my list of 10 and 12 well-chosen stocks, and I can confirm that other people are buying those in funds, and that there's 4 or 5 funds across the board. And so Cat Tractor, check the box. Tesla, check the box. And it should be paying a dividend, because dividends reinvested over time are how you have consistent insured gains, and the options allow you to insure. And so let's talk about the second one, buying into strength. Once you have that well-chosen group, the idea that you don't just buy anytime. The unfair advantage here is that if you learn to use the daily, weekly, and monthly charts to find support and resistance points where that stock has pulled back and found support to continue to go up. You don't have to be an expert at chart reading to find support and resistance areas. They're very, very easy to see. I can show you on my charts right here support and resistance areas across the board on the NASDAQ, but let's just look at John Deere, for example. All right, we'll look at the daily chart, and as you can see right here, if we were looking at the daily chart to find a support and resistance area, I'm going to draw a purple line right there, okay? You can see that here's a resistance to the rise, and then it supported and rose off of it. It came back down, found the support, and then started to rise. That kind of idea, when you do that in conjunction with not just the daily, but also the weekly, because you're going to own this for years, you can find those support and resistance places where you're not just going to buy. Come on back to me, man. You're not just going to buy off the cuff. You're going to wait and have that well-chosen list, and you're going to look for periods of time where the charts are setting up for you to buy into strength. And then even more than that, the beauty of what we're doing here is also understanding to buy when everybody else is confused. Okay? I don't just frame the model of investing around I'm going to buy any willy-nilly time. Once I know how to read the charts, I'm going to look for places in the time of the year when the majority of people are selling off, allowing the market to come down to meet me at a place where I can buy into strength. And we're going to talk about a whole calendar that the stock market is really you can really build your plan around that in a minute. But times of the year where really good long-term buys can be found are like right now. I'm recording this in the summertime, June, July, August going into September, or October, after the possibility of a large crash doesn't happen, or even if it does happen, once we find a floor, going into November strength, good buys. And you don't just buy it, you look for the chart periods to show you. Beautiful, beautiful thing. Okay? Insuring your stocks. Here's the thing. You guys are here to learn. You've either purchased this or shown your willingness to do the work. Options are not for everybody. I know that. I've learned that over time. But once you learn the power that is in having options in your tool belt as a tool to use, when your stock looks like it's going to tank for a long time, you don't have to be an expert chart reader to see. Let's just go back to my charts here and look at the monthly on John Deere. It hasn't really had a huge downturn, but we'll go back to the last time I insured it, which was right around here in January of 23. That stock was going down, and you could see on the charts that it was probably going to go down for a few months. There wasn't any guarantee. Come on back to me, Lee. But there was a possibility. So you take all of your shares in John Deere and you go to put options and you find a strike price that is 2 or 3 strike prices lower than your current share price of your stock. And you buy 1 contract more than you have shares. So if you have 300 shares of John Deere, you're going to buy 4 put options contracts, which insures you for 400 shares. You're never going to be exact on the selling or the buying of it, but you're going to get the chunk in the middle that allows you to offset the loss in your long-term stock. And generally speaking, I have found that there's even, in really, really huge downturns, profit to be had over that period. All right, just to kind of wrap things up, I got this over here to the side. My very esteemed colleague there is operating this great. Investing for more than retirement. We just did a whole 13-minute spiel on this. This is important because, yes, investing, wealth building go hand in hand. Warren Buffett, many, many others have built long-term wealth in buying quality companies. So the approach is still and always will be the majority of the money should be funneled to long-term assets. However, the idea is to build wealth, not just to retire. So keep that in mind as we build this out, is that we are changing the mindset from being investors like everyone else and sheep and following the herd to being lions, to hunting the prey that we want, to taking control of and reaping the benefits from being the one with the right mindset and the preparedness to attack the market and take the money from the people that are unprepared, because there's plenty of them out there. The idea is important that the mindset is proper, because the mindset is where you become a person that knows, and the fear lifts of, am I going to be able to have enough? And then you get to a point where you're a person that what the stock market will do for you is allow you to alleviate the problems or the fear of or the stress of having enough, not knowing where your money is going to come from for the rest of your life, because you can build out the troughs. And the one most important, biggest trough is investing for wealth, not retirement. You don't just buy the funds that everybody else buys. You buy the companies that are going to allow you to see the biggest return on your money over a window of time. You don't just buy when everybody else buys. You buy into strength after you have a list and a proper understanding of what you're going to buy. Then you go and look for places to buy it. And you buy a portion of it when the market is down and getting ready to move into a strong period of the year, like October through January. And then you can buy a second piece of the same stock as it begins to move up into a November rise that doesn't always happen, but is a place to look historically for rises in the market. When everyone is confused, you are prepared and standing in strength of understanding because of that preparedness. And then having the ability to know that just like everyone else has that idea of, I'm going to hold forever, hold through all the downturns in the market, you don't have to be fearful of those downturns in the market, because you're not just holding through the downturns. You have options to ensure that the downside protection on your long-term holdings is there. That's a big piece. And we talked about all that. And I can go in depth on each one of these if I wanted to, but this is a foundational idea, because this is a rest of your life thing. You are embarking on a journey of changing yourself into a professional stock market operator and using the stock market as your vehicle to build long-term wealth, and using the stock market as a way to then generate, and we'll talk about this in a minute, generate extra income to invest in those assets. And each one of you has specific things that you know more than everybody else does about, such as, I'm a big online asset builder, right? And I research that on a regular basis. So in my long-term holdings, in my vault, I don't just buy stocks, I also buy websites and build them out. I also use the money to invest in certain businesses locally that I know enough about that I have a sphere of confidence in understanding that business model. And I'm never owning a huge chunk. I'm a minority investor so that I don't have to take on the stress of the business ownership. My money plays that role for me. And that's where you can get to. That's where I want to get you to. See, when you think about long term, and I'll say this and we'll move on to the next piece. When you think about long term, you have to really think, is buying and holding for your entire life the most educated way to do it? It is a way, but think about the Dow 30. Once upon a time, the biggest companies in the world made up the Dow 30. And for years and years and years, people made fortunes by owning those companies. I can't think of a single one of the original Dow 30 that are around today. Back in the day, during the dot-com bubble, I know a guy that made a lot of money, but really lost more because his big thing was tech stocks, and pets.com was a big thing then. And all the pundits in the news media were talking about, this.com and that.com and pets.com, and nobody at the time wanted to buy dog food over the internet because the infrastructure wasn't right. Amazon wasn't even a thing. They were thinking about, books as Amazon's future, but what everybody didn't realize is that Jeff Bezos was building out the infrastructure to distribute. And once he got that right, he became the go-to guy to deliver your pet food at home. And then, of course, Chewy came out of what pets.com really was, But if you own Pets.com forever and never moved your money into anything else, you'd be at zero today. Cisco Systems. There's people that owned a lot of Cisco Systems stock that were millionaires in that stock and were proud of their ownership in Cisco. I just love my Cisco. Or Ford. I just love my Ford. If you love and you fall in love and you invest for forever, the stock and the company, when it eventually loses its competitive edge, will hurt you and your family. So you want to invest with the end in mind. You want to know that, look, I'm going to ride this stock until I feel like the stock has seen a good chunk of its movement and it's not moving like it did before, and then I'm going to sell and move out into my next piece of wealth building. And there's a whole idea in there of when you sell, how do you sell, and a lot of wealthy people don't sell their stock, they borrow against it to use. But that's in a different account. That's in a different way of building this profit cycle business that we're talking about, okay? And we'll move on to the next piece here, Lee. The profit cycle approach. Now he's going to put this back up on the screen there for me. The profit cycle approach to asset building. Now, a stock market asset comes from turning it into at least a 3-pronged profit cycle, if not multiple pronged profit cycles. Assets generate income without you being there, correct? So this is not a foolproof total asset. All right, so now you understand that we've started with the biggest piece, the most important piece of this model, which is building out a long-term thought process and ownership in quality companies, with the idea that long-term nowadays doesn't necessarily mean 20 and 30 years. I generally check mine annually with a target of selling out in 5 to 7 years and rolling over, unless I can figure out a way to hold on to that company and use the money to put into another asset. But now we're going to talk about the big piece of this, which is, okay, I know how to buy, or I know what to buy, and I know how to buy, but I don't have a lot of money to buy. How do I become a long-term stock market investor if I am cut off at the knees by only having a small amount of my income, earned income, to move into the stock market annually? Well, that's where this next piece comes into play, the profit cycle approach to the stock market. The profit cycle approach begins to build an asset in the stock market, and it's a 3-pronged approach and eventually multiple-pronged approach. It's building troughs of profit, creating the foundation, buckets or accounts for each major financial goal you have in life. An example is trading for investable money and trading for buying fund rewards. And then profit, creating an IRA or a 401k if you do plan on retiring. Or even if you don't, having an IRA can be a very profitable place to build huge compounding wealth using the right techniques, because it's growing without taxes, right? Success requires you to have peace of mind, and no one can have peace of mind believing 100% of the time they don't know if they can eventually step back. And I want to give you 100% peace of mind that, hey, I know how and where my long-term money is going to come from. And then practice more than you take real action in the market. That peace of mind comes from. You have to look at the stock market as a place where you get paid like a professional athlete without the time limit on your body. Come back to me. See, that's how I have been taught to look at it, and it's really powerful, because all pro athletes get paid ridiculous sums of money, but it's not outpaced to what they make. If it was, then every NFL or MLB company would go out of business. These guys make tons more money than they produce, and they generally have a 10-year cap on their earning potential. And if they're not smart and they don't become an investor, they lose out eventually. You, however, can become an athlete in the stock market, can learn the stock market in a way that most people never understand, and with a big time put into the effort up front, and eventually get to a place where I spend about 2 hours or less a day in the stock market, but I generate multiple more money, multiples more money that I don't want to really say what I generate, but it's multiples more money than I ever thought possible through the stock market, and way more than my earned income. And so the correlation between getting paid, $500 or $600 an hour isn't there anymore. I get paid way more than that versus the time I put in. But you got to start with the idea that we're going to build out first. So now that we understand the long-term buying and holding, or buying and eventually selling of assets, which is where wealth builds, the profit cycle asset approach to the stock market will allow you to use the stock market to generate more money, and also to generate eventual replacement income, so that you can then focus on other things that you want out of life, which is the creation of the foundation of the bucket approach to multiple accounts for what you want. All right, come back to me. The way that I look at this is like long-term vault building is one account and one approach. And all of your dividends that come out of ownership in quality companies are going to go sit in that account, waiting in that account in cash for you to redistribute them when the time is right, and when you're going to buy more of that same stock with those dividends. Then you can, if you want to, if retirement is important to you, open a second account where in that account you're going to funnel small amounts of money that are eventually going to build up to replacement income. And how you figure out replacement income is a simple mathematical formula that's on your sheet you have, that's 20 times your gross monthly income. So let's say you made $80,000 a year, $4,000 a month, even if it's not take home, even if your take home is, after tax money, let's just do pre-tax money here, $4,000 a month will provide you with enough money that you can guarantee that you will not have a lifestyle change if you can't work anymore, or if you don't want to work anymore. So 4,000 times 20 gives you that figure. And whatever that figure is, if you do 5% of return on that figure, you're going to see that it equals out to what you need. Now, the way that you get to that figure and build up over time is by starting with a small amount, whatever you're comfortable with. I say $3,000 to $5,000 to $6,000 is pretty good, because what you're going to do is take that money and you're going to trade stock with it. You're going to find companies, and I use a channeling stocks format, which means I look at companies that are in a channel that have a chart formation that allow me to wait until it breaks out of that channel. And I'm going to buy the stock, and I'm going to use all the money in that account, and I'm going to buy as much stock as I can, and then I'm going to eventually sell a covered call with the ownership in that stock, covered by the ownership in that stock, that produces a percentage return that, coupled with my selling of the stock after the covered call expires worthless or is bought back for less money by me, totals the return that I need. If it takes 2 months, then my goal is 10%. If it takes 1, 5%. If it takes 3, 15%. And generally speaking, once you get the hang of this, 10 to 20% over a month or two period is not difficult to get, and you'll see that. I'm not going to spend a lot of time on that here, because everybody has different goals in mind of how they want to retire. This is just the most prevalent way, in my opinion, that will allow you to easily manage your life through the stock market without a lot of time spent on task. and then you can go do whatever else you want to the rest of the month. That, in my opinion, is real retirement or income replacement. And that's just one account. So you've got 2 accounts now that you're working on. Where is all this money going to come from if you're trying to fund both accounts with just your income? That's where the profit cycle approach produces a really beneficial idea, which is looking at the stock market in terms of how many different ways can you cut profits out of the stock market. See, I look at the stock market as a place where you go and you hunt for money. You hunt for profits. You're not looking to take home a trophy when you're out there hunting. But if you see a trophy buck, you're going to take a shot at it. You're going to take a shot at it because it's there. And that's the way that I look at the stock market in terms of trading. That's the third piece of this. And you can trade for profit to add to your vault. You can trade for profit to add to your income replacement. And you can trade for profit to buy fun, nice stuff. You know, I buy watches with profit. I buy headsets with profit. I bought entire stuff to put in the studio with stock market profits to educate and help people, because this is what I love to do. You fund your passion in the stock market through volatility, and that is the important piece that a lot of people, I think, leave out of the market. They look at it as a long-term place without seeing all these short-term opportunities out there. And also, if you just look at it from a short-term opportunity standpoint, you miss all the long-term wealth building. So coupling them together is where real stock market assets are built. Now, the trading portion of this is where we're going to spend the rest of our time, because the trading portion is very in-depth. Okay? But I use options as a way to trade the stock market. You can do your own thing. And you're not going to be able to leave this webinar knowing 100% of enough to go out there and trade the stock market with just options. You're going to have to figure out your own way of doing this, because my way is very specific to my time frame, my money, and my goals financially in the stock market. I don't trade a lot of stuff. I trade a very specific handful of stocks that move $5 to $6 a week or more on the regular. I throw in indexes like the QQQs or the XSP or the SPY, because they are extremely profitable at certain times of the year. And I have in my trading basket of stuff a large amount of 60 plus stocks that are rolled over at any given time to only give me 12 to 15 to look at every single week for trading opportunities. Because I'm not trying to have a job. I'm trying to find a stock, get the chunk out of the middle, pull the profit out, pay a third of it on taxes, leave a third of it in the account, move a third of it to where I want to move it to. And then I have a second account that I only buy fun stuff with the profit, but I do the same trade. So 2 accounts going in the same trade. And that does mean when I lose twice as much. I have to cut my losses very quickly that way, because I don't have to have the money and I don't need the headache. So if the trade's not working, I'm out quickly. And a lot of trades have turned around on me and gone the way that I wanted to after I got out, because I don't tolerate sideways. But hey, you can always get back in. And also remember, you're never going to make all the money in the stock market that's available in the stock market to make, period. So keep that in mind. With this being the Unfair Advantage webinar, that is your unfair advantage, the approach. Not how you trade, whether you trade options or futures or commodities or Forex. It's the approach of the money management of moving a piece of the trading profit to your replacement income account and to your vault income account or your vault wealth account. Because If you only took $10,000 out of your income every year and invested it over a lifetime, earning 10% a year, you'd have about $1.8 million in 30 years. If you took that same 10 grand and cut it in half and kept 5 of it in the stock market and invested the other 5, and then kept doing that with the idea that it's going to grow at 10% over here in the vault and about 20% to 60% a year over here in the trading account, you're going to eventually have $15 to $20+ million in the vault, let alone what you have in the trading account over the same 30-year period of time. That is the approach that can change your life. That's the difference. Now what we're going to talk about in unfair advantage terms is looking at the stock market from particular times of year and dividing them up so that you're not always following the crowd. Okay, there's a thing on the screen called calendar planning. The idea here is, and I know it's a hard thing to wrap your brain around if you've never heard this before, but the stock market moves in and out of months and zones differently, as if it has characteristics during certain times of the year. Come back to me. What causes that is not so important as being able to profit from it. The causation, as long as it's there, really doesn't matter. But it has been there for years and years and years, at least 100 years that I can historically track. And I believe it's big money that causes it to move that way. Big money, earnings, interest rates drive the stock market. Not really news so much, not pundits on TV. And that's why when you really want to think about the stock market, you want to think about the fact that the profit cycle approach is first and foremost. Not news, not pundits, not distractions. Because once you have your plan in place, that's going to be one of your biggest superpowers if you can shut off the world and just work your plan. Because doing the stock market this way and getting your professional person that does your money management on board with this way is the difference in thinking in terms of decades versus a year, trying to have a hot pick, trying to have a good profit, trying to, We look in terms of decades. And in 10 to 20 years, your life will never, ever be the same if you discipline yourself to your plan. And your plan that's written on that piece of paper is what stocks you're going to buy, well chosen, the 10 to 12. Why are you buying them? What research backs up these companies as being good and the dividends as meeting what you want? Because you're also writing down there what your long-term wealth plan is. How much money you want to earn from the stock market, the lifestyle that you want to have, where you want to live, and why. And what your focus is long-term if you want, time with your family. Or if you do want to be Warren Buffett. That changes how much time you're going to spend on this. And then below that is your income number that you need for replacement. And then below that is your trading account, where it's going to be, how you're going to trade, and how much money you're going to start with. Because the importance of that is you should start trading with less money than you invest. If you only have $10,000 available to you right now, please, please, please put 6 or 7 into long-term investments once they are available to buy, and the 4 or 3 that are left into trading. Because I will tell you, just so you understand, to learn how to do this well, I have taken 3 accounts to 0. 0. Meaning it started, grew it. One account I grew to above $25,000 before I took it back down to zero. Here's the two things that are important to know about that. One, it's the only way to learn is to fail your way to success in this profession and arena. Number two is every trade that I won on, I moved money out of the stock market and into the vault. So when I took it to zero, I still had successful long-term holdings to show for my work and my effort. And you can too if you keep the money management proper. See? The seasonality of the stock market. Okay, calendar paneling. Let's look at January. January and February. Pull that up for me, Lee. Earnings season. It's one of the best times of the year to trade in the market. And we're talking about trading here, not investing. Although if you are trading stock instead of options, it's still a great time. February often sees a notable decline around mid of the month. Watch both middle of January and middle of February as a place for profit taking. Moving on from January, February is March warning season. March is a small period of time, 1 month, where upward movement after any February sell-off is usually found. Typically upside movement in the middle of the month of March. Now, April. Generally, we expect the first half of April as earnings season begins to be especially strong. And going into tax season, around the 15th of the month, or the 18th, there's often potential for another large decline. Now we enter the summer. Come back to me. The importance of the differences in these time zones are that, one, they're not specific day to day, meaning you don't just see from April 31st to May 1st a change. It's gradual. Number two, going into the summer, if you're trading options or futures, you're going to see a lot more choppy market action than you are in January and February and March and April. Right now, as I record this, last week the NASDAQ was up and down by hundreds of points every day during June. That's what I'm talking about when I talk about choppy. That's great for a trader, but for an investor, if you don't have the right mindset, it can be jarring. So just keep that in mind. May earnings tends to be a 50-50 month. May typically heading down. June warnings. Pull that up on the screen for me, bud. May earnings tends to be a 50-50 month. Mid-May typically heading down. June warnings, a potential rise. 7th to the 25th of June. Summer months can be choppy or completely dead and sideways. July earnings kicks off an excellent time for trading opportunities. And July into August, you're still kind of in the summer. In late August, after earnings begins to fall off, you're looking for, and I have some weird October bats picture there, but it's because we're going from August into October. In October, after earnings kind of falls off and is over with, fairly prevalent, sometimes significant decline. Expect a fall or a large decline often late September as well. And later in September, the last 3 to 4 days going into October, can usually find nice upward movement into a good part of October, I would say. And then often after that, there's a period that we call the October crash. Come back to me. Every October, big money in the market sells off their losses for tax purposes. And this selling off can either produce a small decline or a significant decline into a crash. And you have to be prepared for either one, because the amount of times the market has crashed in October, it's staggering. Staggering. Going back into the 1920s. So, if you're not prepared for that, then you are not going to profit from it. But if you're prepared for it, then late October into November is a time where you're looking for buy points in stock and options to really benefit from that shoot into November. And I'll just kind of show you on my screen here. We'll just pull up the QQQs for easy. Go to my charts, Lee. Daily chart. Here we are. Boom. Okay. You see how November had a decline? There was major profit taking. And then mid-November, it began to shoot up again. That's what I'm talking about. That's what I'm talking about. S&P 500. Same deal. If you're not, come on back to me, Lee. If you're not prepared, you can get kicked in the teeth. So you want to be prepared for that. Now I'm going to go back to the months here, and then December. So we're looking at earnings in November. Expect a 2 to 3 month period of up. It doesn't always happen. As you can see this year, it did not happen. Into Thanksgiving. December warnings time after the November and October earnings. December warnings can be a good month because of the Santa Claus effect. But look for entry possibilities around the 15th to 20th of the month of December. Okay? Come on back. The idea here is that this calendar, if you will, is one of your greatest unfair advantages if you use it. If you don't, because you don't believe it, I bet you that it won't take you longer than a year or two of watching to see how well the market responds to this calendar for you to begin to believe that what you got within this webinar was way, way worth it. I just really, this is everything I wanted to talk about today. We've covered it. The market is a place where when you approach it with real long-term thought process, it can be beneficial. But if you only attack it with long-term thought process, you may or may not get to where you want to go. And I say that with love and respect for any of you out there that have great people managing your money. Because not everybody does. And I have met, just so many people out there that are frustrated with their investments. And they approached the market with that, I'm going to invest. I'm going to be long-term, respectful, and hopeful. I'm going to save and invest my money. And they're doing better than inflation, but because they don't earn 6 figures, they can't put enough in to make it worth their time. And that's the key, man, is making your money earn money for you, and then using those money babies to invest changes the game. And then using that calendar along with it, and then using the idea that you can also replace your income so you don't have so much fear, and so you can spend more time not only with your family, but you can spend more time becoming an educated investor and adding more unfair advantages to your playbook. That, over time, will make you a I'm just going to grab this multi-millionaire, because this is what you should be doing. We're going to end on this. Becoming a professional. Market journal daily, borrowing versus selling. Buying gold and silver, and planning each month out. Come back to me. Every day, I write down in a journal what the NASDAQ did, because I follow the NASDAQ pretty religiously, but you can pick your own index. What the Dow did, because the Dow still affects the market. How much it moved up or down, and how much percentage-wise it did. One news item as to what I think affected the market, mostly so that over time you can see how little the news does affect it and what really affects the market. And then I write down what I did that day to learn, the work I did. I write out where my 10 to 12 well-chosen stocks are, and are they ready and at a place where I can purchase them. And then if I'm trading, I write out a list, a short list of what I'm going to trade the next day, why I'm trading it, and where my entry point is. And then I go into the next day with an attack plan that is built on yesterday. I'm prepared. The market journal helps you do that. And then I keep a market journal Bible, really, that has every stock I ever want to buy or trade in here. How it moves in each one of those months and movement periods. How it moves around earnings and what trade potential and possibility there is. How specifically I'm going to trade in each month goes into a plan that goes into this, and then I write down on an index card or a piece of paper, because it's a short plan, it shouldn't be overwhelming, and I use it as like a business plan of attack for the market. That's being prepared. The borrowing versus selling really comes out of me learning from some very wealthy people that borrowing against the future earnings of your stock, when you have an opportunity that presents itself out there in the world, business-wise, real estate-wise, is incredibly smart. I can think of a few very wealthy people that don't even have incomes. They borrow against the stock in the companies that they've started, and they use that to live off of. Now, that is a whole different webinar, but if you never sell, the capital gains don't eat you. And it's just a smarter way to do things. Buying gold and silver is a hedge against inflation. And if you use the $XAU index, it's a gold and silver index that I follow regularly, you can go to your favorite gold and silver buyer and watch as the prices of gold and silver plummet during a decline, and then use those charts. Let me just show you. I'll just pull it up. All right. XAU, which is a gold and silver index. The last time I bought gold and silver, after our huge March decline, right around here, I started buying some more gold and silver. I bought in strength. You can do the same thing. And if you want to go even further into like a weekly chart, gold and silver has been in an uptrend since 25. And using charting software, you can see that uptrend begin, and you can buy into that strength, and it changes the game. Come on back to me. The profitability there is not what counts. The fact that you are hedging your inflation and your money being eaten away by owning gold and silver, and not just buying it silly and stupid, but buying it again the same way you buy long-term assets, with real chart-minded purchasing. I just think it's smart. And it's another unfair advantage that you have in your tool belt. It's a really big piece of it. And then planning out your trades. I know a lot of people that day trade, and if you are a day trader or if that's your plan, that's one thing. But for me, the market provides 10 quality trades a month. And I don't always do every 10. And I get 10 based upon having about 15 quality stocks to trade that don't all move at the same time every month, but trading with the market that stock trades with. QQQs, NASDAQ, Goldman Sachs, S&P 500, that kind of stuff. And waiting for a planned move to happen in something like Goldman Sachs around earnings based upon researchable chart data where it kind of starts to move a week or two before earnings release, a week or two after earnings release, writing it down in my Bible and then saying, okay, now I'm going to go and I'm going to wait for this to happen. And when it does, I'll be there. And if it doesn't, so what? I've still got the research and I'm prepared. And it allows me to have the confidence that, hey, I'm not just throwing my money at something. I'm making a decision that is backed by data. Big piece of becoming a professional versus just like everybody else. And I'll wrap this up with just the idea that, look, I don't think that a lot of people realize the power of the compounding of this on your money. And how when you get each piece right, you don't have to be right every time once you get it in place to have all the cylinders popping off. I can't stress that when you're, this Kiyosaki said something that really made me think. See, when you're in school, we all get taught that failing is a matter of negative. When we get something wrong or when we fail a test, it's because we've done something wrong. And we get into this mindset that being wrong and failing are one and the same, and that they're just all negative. Whereas in life and in the stock market, you really do learn by failing forward and by being wrong enough times that you learn where and how to be right. And you don't have to be right every time in the stock market to win, because being right 70 to 75% of the time, as long as you are wrong and know you're wrong and get out in a timely manner and admit you're wrong and don't let it hang you up like a deer in the headlights, that 75% being right will make you rich over time. Keep that in mind. Use the worksheet. My email is here if you have any questions. If you haven't joined the Underaccredited Investor newsletter, that is the best place for us to communicate. Thank you for being here today, and I hope you got a lot out of it.